Hello and welcome to another MEI Global Supply Chain Improvement Series e-learning program. My name is Alan Dunn. I'm the president of GDI Consulting and Training Company and the founder of the Manufacturing Executive Institute. I will be your host and your instructor in this important program titled The Fundamental Economic Model of Manufacturing. In this program, we're going to teach you about a model that you can use to prioritize improvement initiatives and rationalize how enterprise value can be impacted by your various improvement initiatives. This topic is really important and, in fact, urgent for at least two reasons. The first is that profits do not illustrate a story of shareholder value creation. In this program, we're going to talk significantly about how profits can be misleading, how the depiction of profits can give one a false sense of growth or a false sense of value. This is also urgent because without understanding valuation, or what we like to refer to as valuation thinking, you simply cannot establish improvement priorities. So these problems, these issues are really important. Our mission today is to provide you with some tangible solutions to these problems. Let's start by talking about the single most important goal in your manufacturing company, and perhaps even for global supply chain management in general. Is your goal to win the game? That's a metaphor for driving costs down or driving delivery improvements up or simply improving performance to one customer or improving your profits of your organization. Is it about winning the game or is it about winning the championship? That, again, a metaphor for dominating your markets, creating increasing shareholder valuation, moving the stock needle on your company upward. I would argue that winning the championship is always far more important than just winning the game. So we're going to talk about shareholder value to start here. The first thing we need to understand is that shareholders are at complete total risk, and you're probably going to hear that several times in this program. Even lenders, a stakeholder, are not nearly at the level of risk that the shareholders are at. That's because lenders typically have collateral. They have security for the money that they've loaned your organization. There are other stakeholders, to be sure. There are suppliers, there's the community that supports all your employees, there are the employees themselves, there are the customers, perhaps the most important of all stakeholders. Without customers, there's no company. Without customers, there's no P&L. Without customers, there's no balance sheet. Without customers, there's no enterprise. So customers are a very important stakeholder. In fact, it's been said that the road to shareholder value is paved with satisfied and happy customers. And then our channel partners. Channel partners are those intermediaries like distribution companies for material on the way in or distributors and retailers for products on the way out, ultimately to your consumers. So indeed, you can see that there are lots of stakeholders, and stakeholders are important. We cannot execute our strategies without stakeholders. But shareholders are who we work for. We do not work for the stakeholders. We work for the shareholders. The stakeholders are a way to improve shareholder value. So that takes us to what we like to refer to as a moment of wisdom. These are mental models you should remember for the rest of your life. There are shareholders and there are stakeholders. In an economic enterprise, honest and sustainable shareholder value is always the ultimate goal. It is the responsibility of the enterprise's leadership team to determine and execute the proper strategies to achieve the ultimate goal, including the roles and expectations of the stakeholders. That leads us, interestingly enough, to another moment of wisdom that we all need to remember, and that everything leaders do to enhance shareholder value must be tempered with a mandate to be legal, ethical, and moral with all stakeholders. If you bury environmentally sensitive waste in a pit in the back of your factory, you're going to affect the community. And by the way, that's immoral and certainly illegal, and probably will also damage your shareholder value in the future when you get caught doing it. So these are things we don't do. We don't do unethical things in business. We don't do illegal things in business. And we do not do immoral things in business. Doing everything legal and ethical and moral is, in fact, supporting the mission of shareholder value. Now, there's actually two value propositions when we look in a business. The first value proposition is going to be probably the most important one, and you'll see why. We use these propositions because they help to keep us focused kind of on the right priorities. So the value proposition to the customers is arguably the most important proposition because, again, without customers, we don't have shareholders to provide value to. So the two value propositions are really important. But what's really important is that a lot of leaders, in fact, the vast majority of leaders of manufacturing companies that I visited in my 40 plus years of consulting, seem to misunderstand the term growth because they don't understand the difference between the value proposition to customers and the value proposition to shareholders. Let me give you an example. So a number of years ago, I was at a cocktail party in New York City. In the top of one of those buildings, there was a big meeting room, and there was a lot of individuals in that room. There were investors, there were CEOs, there were analysts, and there was myself. And this was put on by one of the major financial news magazines. And so as I was listening, as I was standing there in the middle of this group, I was overhearing some conversations. I heard an investor ask to a CEO of a company this question: what is going on with your company's growth? And the CEO responded, we have 16% average sales growth over the last 5 years. That CEO did not understand that sales growth is not economic growth. We can have sales growth all day long and actually lose money and actually have negative cash flow if we haven't priced our products properly. The investor understood that. I also heard behind me a comment from an investor to an analyst. The investor said, gee, what kind of growth do you think XYZ company is experiencing? And what was really interesting is the analyst said they have grown their productive assets over 10% each year. This analyst didn't talk about the growth of the company's sales, did not talk about even the growth of the company's profitability. He talked about the growth of their productive assets that create sustainable long-term value. To me, that was an important cocktail party because it really showed me, I heard it firsthand, that there's a difference in the terminology in between the owners of companies and those who run the companies on behalf of the owners. So the P&L story is an important one, but it's not the most important one. Being able to grasp the P&L story does not translate necessarily into financial intelligence. There's just so much more to your business and your business's financial story than what's recorded on the P&L. So I want to talk a little bit about the best economic performance metric, which is really inspired from geometry. This is a metric inspired by geometry is because when we looked at composite shapes, we said a composite shape is any shape which is made up of two or more geometric shapes. So that leads us to the concept of a composite metric. A composite metric, performance metric, is one that's made up of two or more views of the business. And so what we need to know in a manufacturing company is how much cash is being created by our suite of gross assets. And I might need to know that by business line, by business unit, by division, or by company as a whole. But I need to know how much cash is being created from the suite of gross assets. And that leads us to a moment of wisdom. Cash is to an enterprise what blood is to a biological life. Cash carries sustaining nourishment to every organ in the enterprise. Reduce blood or cash, and neither entity does well. We need to protect the blood of our organizations. So with that, let's show and demonstrate a valuation metric. Here's a valuation metric that all of us in manufacturing companies should ascribe to. We should measure performance of a factory, or measure performance of a company, or measure performance of a business unit based on the operating cash flow divided by the total gross assets minus total current liabilities. This is a valuation metric. The operating cash flow comes from the performance of the company, which is depicted on the P&L, and the denominator is depicted off of the balance sheet. So the numerator is from the P&L, the denominator is largely from the balance sheet. Let's dissect this a little bit more. So my first note there, which is how to calculate operating cash flow, that equals the net income. Net is underlined. That's net income after taxes and after interest. Add back the non-cash expenses like depreciation, add back the changes in working capital, and then add some adjustments, add or subtract some what we call economic adjustments. So, for example, if you sold a building and had an extraordinary piece of income, we would subtract that out because it's not from operations. It's an extraordinary receipt. The same thing as if you had an extraordinary expense that'll never happen again, we would subtract that out. So economic adjustments are important. Most CFOs understand these. Most boards of directors have to approve these. And so there's no mystery to those. But that's how we get operating cash flow. We're really trying to get the real cash flow after taxes and interest as well, because those are real costs, by the way. Now, notice in there when we talked about changes in working capital, I want to go to note number 2 here, which is that's the increase or decrease in accounts receivable plus the increase or decrease in inventories plus the increase or decrease in trade payables. So think about what working capital is. Working capital is the microscope into the competency of your operating management team. Think about that. Working capital tells you how effectively you're able to collect your receivables, how effectively you're able to manage your inventories, and how effectively you're able to manage at least the economic aspects of your suppliers. So this is about operational competency, if you will. And so that's how we get change in working capital, which is part of the operating cash flow. That's how we calculate it. Now let's get down to the denominator. Total assets is total tangible assets plus accumulated depreciation. In other words, we're adding it back in order to gross up the assets, because gross assets are the only way we compare one company to another. And then we ascribe intangible asset values and add it back. So, and we'll talk in a minute about intangibles. This is the value of the things that aren't on the books. So, for example, you might have invested for the last 5 years in research and development, and you're relatively close to having a new product, but that new product isn't to the market yet and therefore has no cash flows associated with it. But it has pent-up value. And so there are ways, and we won't go through them in this e-learning program, but there are ways of determining the pent-up value of research and development and the pent-up value of other intangible assets. So we add those back, make some economic adjustments. Again, if we sold a building or did something like that, we would make those adjustments. In terms of all of the assets of your business, there's 10 of them. There's 10 categories. There's property, plant, equipment, cash and financial investments, receivables, net of payables, and inventory. Those are all your tangible assets. Some are short-term, some are long-term, and like equipment is kind of an in-between, kind of a moderate term. But then we have intangibles, people, capabilities, intellectual property, brand equity, and timing advantage. Now let me talk a little bit about those. We understand that some companies have greater value because they have superb management teams. So if we just looked at Berkshire Hathaway's, for example, we would say because of Charlie Munger and because of Warren Buffett and because of their incredible knowledge of investing principles, and by the way, their discipline of sticking with some of those principles, they add value to the company itself. In fact, there's been studies of what happens when those two individuals are gone from Berkshire Hathaway's, and the value of the business would probably drop. And so it's really important that we understand the people capabilities. Intellectual property, we talk about what's the value of patents, what's the value of trade secrets. Brand equity is the value of the name recognition and the brand recognition and the brand ownership by consumers. When we talk about ascribed value, that means we have to go through a fairly complex process for ascribing some value to these. And timing advantage is being in the markets at the right place at the right time, and it's usually a short-lived sort of advantage, as is, by the way, brand equity. Even though I have question marks over on the time frame, there's a lot of studies and a lot of data that suggest if one stops advertising and promoting, brand equity after about 2 years begins to diminish pretty quickly. Here's our moment of wisdom from all of this. Some of the most significant assets can actually be intangible, and so we cannot overlook those. I'll give you some examples. Dolby Company. Dolby does not actually manufacture anything. Dolby develops sound engineering principles and algorithms. Dolby creates algorithms that either enhance, create, or manage sound. And they license those to huge numbers of companies in the media space. Blue River Technologies, now owned by John Deere, developed software and, again, algorithms that help vision systems in the agricultural marketplace. Google is nothing but an algorithm-based company. And Nike, well, that swoosh mark on your screen is probably the most important and the most valuable asset of all. Just I put that swoosh mark and you know it's Nike. I don't even have to put the word Nike on there. So we know there's value to that. How much value? That's the question. By the way, intangible values can usually be determined when you sell the company. That's what goodwill is. Goodwill, after the fact, is always the premium you paid for the company, but the calculation to get to that amount almost always starts with, we think we have the best management team, or we think we have the best IP, or we have the best timing advantage, or the best capabilities in the marketplace. And so the goodwill ultimately is really determined by the company's competitiveness and sustained competitiveness in its marketplaces. That swoosh mark, is evidence of that. So we have to develop this mindset of what we call enterprise valuation that has to kind of replace how big are my sales or how big are my profits. And so we have an example of a $23.4 million operating cash flow divided by a total assets minus liabilities of about $204 million. That gives about 11.4% enterprise value, if you will. And by the way, this is really referred to as cash flow return on investment. We're going to talk more about that term in a minute. But if you take a look at across companies, and this is a truism, and Credit Suisse, Holt has done these studies over the years, and so they've identified that public traded companies in North America and Western Europe and even Eastern Europe, for the most part, average about 6.3, and private companies about double that. They haven't done the private companies, but we've done analysis of private companies, and we've noticed that it's about double. That's kind of the difference in the cost of being a public traded company versus being a private company. So Holt Value Associates, before it was purchased by Credit Suisse, created this concept of the relative wealth chart. Now, every single money manager, the 4,500 and some money managers in the world, have these relative wealth charts for every single public traded company in the world. And so it's the top of this is the cash flow return on investment. It's the numerator, and the bottom bar chart is the gross assets, and that's less liabilities, current liabilities, and so that's what we call the also oftentimes asset conversion or asset management. So what's important to understand here is that blue lines on the top. Let's talk about the top first. That represents the cash flow return on investment. That's basically the cash flow coming from the business. The green line represents the weighted average cost of capital for that organization. So the logic here is that when you're looking at this chart, is that it's producing far above its weighted average cost of capital. It's generating cash flow off of a suite of gross assets far above its cost of capital. Peter Drucker said that until a business returns a profit that is greater than its cost of capital, it operates at a loss. This is probably the most significant principle in economic profit, and it's proven by this relative wealth chart. Let's wrap this chart up, and let's talk about the bottom side, which is the denominator of our equation. And so when you take a look at this, the purple bars represent the asset investments, and the green line represents the sustainable amount of investment that they can do from their internal cash flows. So in this case, whenever you see the purple bar above the green line, that means they probably have to borrow some additional money. When you see it below the green line, that means that they haven't utilized all the cash generated, from the top part of this chart. So I always like to use an example of Walmart. This is an old example, but it's a great example, and it's very useful for illustration purposes. So let's take a look at Walmart. So this is the Walmart from about 1978 up to about 2002. So it's a bit old, but it's still very useful. So let's just take a look at the top of this. So this is my relative wealth charts. This is my cash flow over gross assets minus liabilities, or cash flow return on investment, a term, by the way, trademarked by Credit Suisse Holt. And you'll notice up there that, again, the blue bars in this case is my cash flow. The green line is my weighted average cost of capital. Nowhere on this part of the chart has the cash generated drop below the weighted average cost of capital. Therefore, this company is increasing the value of itself to its shareholders. That's really important to understand. When that's happening, the valuation is increasing. Now let's take a look at the second part of this. And so this is the asset line, asset growth line. In this case, the purple bar is the asset investment, and the green line is the investment sustainable with enterprise cash. And so that green line represents how much cash is available based on the top part of this chart to invest in gross assets. And in this case, you can see in most periods since 1978, in most years since 1978, Walmart invested substantially more than its sustainable cash. That meant they borrowed money. This is evidence that borrowing is never a bad thing if it's done wisely. So why would you not borrow money at 3 or 4% if you could grow at 12 or 15% your cash flow return on investment? So if you take a look at the top chart, you can see there's probably between about 10 and 15% of cash flow return on investment. And that's after interest, so that means that those assets, even acquired with debt, are paying off. There's a few periods there where it's lower than the green line, but nevertheless, most of it was wise use of assets. And by the way, what is Walmart doing with the money it's borrowing? It's building stores. It's building that which achieves productive value. And then the bottom simply represents the growth in the stock price, the actual market-based stock price. This was based on the S&P. And so you can see in most periods it was, in fact, growing until we get out there to about 1993. So let's just take this first period here, these first several years from 78 to about 1993-ish, and let's just take a look at those. And what's interesting is you can see a growing cash flow return on investment. Now notice, by the way, as the CFROI, or the cash flow, grows in this business, notice the weighted average cost of capital goes down. And that's because the company is more liquid. And as the company's more liquid, it has less risk. It has more months, more years of expense coverage. That's an interesting phenomena that we should never forget, that liquidity can ultimately help to reduce your cost of capital because it makes you less risky company. Let's also take a look at a number of periods in there, a number of years, and you can see a huge number of periods where they were borrowing money to grow the business. And that's because there was substantial demand, and so they felt very useful and very easy to make those kinds of investments. Let's move out to these periods out here that surround 1991. And what's really interesting here is that we started to see the CFROI level off, but we saw assets growing at the same time. So this would cause an investor to dig down and ask, gee, if we're leveling off or actually starting to decrease, if you look at that, that's been largely a decrease in the top bar within the yellow frame that I have. And so it's been going down, but their investment's been going up. And so they discovered that this was Sam's Club, and Walmart was investing in the construction and development and onboarding and onlining of Sam Clubs, a different model, a membership model versus a discount model. And so you can see that they weren't getting returns. In fact, it turns out that each Sam's Club store was destroying a lot of the value of the overall business. But nevertheless, you can see down at the bottom, you can see the results in the marketplace. It started, albeit a little bit of a lag. The marketplace, the investors, the owners started to see this happening. Maybe didn't understand it, but started to see it happen. Now, Walmart management understood it because they manage same-store growth. So they have the data on how every store is growing, including the Sam's Clubs, and finding the Sam's Clubs are not. So the Sam's Clubs effectively are driving down the cash flow investment on the company and also driving up the investment in the assets. So let's now go out to this future period here, where if we take a look, it's kind of leveled off a little bit. It did come down. If I go back a few periods, it was coming down. And this just indicates that sometimes trends are hard to see. Trends take a number of years to see. And then as soon as they started to see it, somewhere around 1994, they started to, or 1992 actually, they started to decrease the Sam's Clubs. Indeed, they actually started to close down Sam's Clubs. Not all of them, but they started to close down some of the Sam's Clubs. So you can see the asset investment continued to decrease. And in fact, when you got out there around 1996, they were actually 95 and 96, 97, they were actually underspending their sustainable investment line. But all during that process, the market was still going down. Now let's go out a period. Notice it took them about 5 years to really solve the problem, but only took about 2 years for the improvement to start to take hold. So you can start to see the increase in the cash flow return on investment as a result of allocating capital to Walmarts instead of Sam's Clubs. And then you can, of course, see the dramatic reduction in the asset investments because they were not investing in the wrong assets. They were now investing in the right assets. And then, of course, you can see how that improved dramatically. And so it took 5 years for it to go down, but only 2 years for it to go up. By the way, comment, same management team. Nobody got fired. Nobody lost their jobs. This is about retailing, and sometimes retailing's a bit of an experiment, and you don't really know what's going to happen until it happens. So this takes us to our model. So here's our valuation model. If anybody wants a copy of this, please write me, please email me. We're more than excited to share this model and give this model to anybody. This is a simplified version of the Holt Credit Suisse model, but it works very well. So let's just talk about what this model is made up of. So we're going to go to the top, and we're going to take a look at the P&L. So here's the P&L, kind of a standard P&L: material, labor, outside processing, material acquisition burden, material burden, factory support overhead. That's your cost of goods sold. And then you subtract out sales expense, sales support expense, brand development expenses, product development expenses, process and research, unmodeled overhead, and et cetera. So you get interest and taxes. And then also we then add back in, we actually make some additions in to non-cash expenses, expensed CapEx, and extraordinary expenses. So ultimately we end up with a total adjustments to cash off of that, off of our total cash. So if we go to the middle, right in the middle where you see that arrow there, it says operating driver. That's our total book expenditures of $154 million. We also have to subtract our non-cash expense, and now we have our total cash expenditure. So that gives us a sense of the P&L. Now let's go down to the balance sheet, and let's take a look at the balance sheet. So we have our cash and liquid investments, our property or facilities, equipment, raw material, work in process, finished goods, accounts receivable, less accounts payable. So we have our tangible assets, then we add back accumulated depreciation, subtract out any asset impairments, and then reclass and add back operating leases. This is important because a lease is just a different way of financing an asset. And if we're going to add back depreciation, then we've got to effectively reclass operating leases as assets from an economic perspective. And then now we have the intangibles. So we have our intellectual property, our people, our brand equity, our timing advantage. I'm not going to go through how all that's calculated. The easiest one, of course, to do is the IP. There's actually models for doing that. And so we add those together, and that's our total gross tangible and intangible assets. Okay, so now we're going to go up to revenue side. So we have product revenue of about $141.9 million. We have some service revenue. We have other revenue. We also have some extraordinary revenue, which we have to take out. I discussed that earlier. So our total revenue is $159.8 million. Now, I also have a field in there, or data element, for growth. So if we think we can have planned price growth or shrink, in other words, it's going to shrink if our products are commoditizing, it's going to grow if they're in demand. If I can raise the price by 5%, that would take me from 159.8 to $167.8 million. And that's really important because now when I go through and I take a look at my annual core operating cash flows, right where the blue arrow is, it's 5.19%, or about $8.2 million. Now, we're going to do this in a minute. We're going to go and we're going to use that grown revenue, that 5% price point improvement. But right now, we have about a 5.19% operating cash flow. So now, if I want to take that to my enterprise valuation, now what I have to do is I have to take my total gross assets, which are about 0.69 turns, and relate those to my cash flows. And so I end up with annual core operating cash flow. That was the 5.19% divided by the 0.69, and I end up with a 3.59% enterprise valuation. Now notice that that is in fact below what I said earlier for public traded companies. In other words, this company is not growing at the rate of its peers. Its valuation, I should say, is not growing at the rate of its peers. Now, if I change all that and move that to raising my price point, if I raise my price point, I get a significant bump in that. My annual core operating flow goes up to 9.7%, down there on the left, right above the risk driver arrow, and then if that compared that to 5.19%. In other words, raising the price is an incredibly important issue. So I might digress a little bit here and remind everybody that we can prove that raising your prices is the fastest and easiest way to increase shareholder value. Now, you may say that's very difficult to do, but here's our point. Reducing your prices should not be the first place you go to be competitive. Reducing your prices should not be the first place you go to be competitive. It should be the last place. It doesn't mean you don't go there, but it should be the last place. We need to find a way to raise our prices by adding value, or by increasing the brand equity, or by satisfying and delighting our customers. We need to find a way to raise our prices. Years ago, during the Great Recession, there was an automobile company that the demand for automobiles dropped down substantially. They raised the price on spare parts, and they were able not only to weather the recession, but actually dramatically increase the valuation of the company to the shareholders. It's because they found a way to raise prices. They couldn't raise it on cars, but they could raise it on spare parts. And oh, sure, dealerships cried, "Why are you raising prices in a recession?" And they said, well, we have to. And even with the dealerships crying and upset, they had nowhere else to go, so they still had to pay the price, the raised price. So you can see a big shift there. So now if I take that and expand a little bit and take a look at the enterprise valuation, it went from 7.0, it went up to 7.03, right where the tangible, the value driver is pointing. And prior, if you remember, that was 3.59%. So about doubled the valuation. So a 5% increase in price about doubled the valuation. In fact, took it from below peer average to above peer average. So this model is very valuable. Now I want you to think about this, and I want to go back over to the left side. Any continuous improvement initiative in your company should be able to be decomposed into how it's going to impact any one of those accounts there, or any one of the accounts on the balance sheet. And so anything you do, you should be able to decompose. Any continuous improvement project, any initiative to improve the performance of the business should be able to be decomposed into its impact, its pro forma impact on the P&L or the balance sheet. And therefore, you can then drive this through and see what it does to valuation of the business. What I'm saying, my friends, is that our selection of continuous improvement initiatives, our selection of strategies, our selection of initiatives to improve the business should be prioritized towards those that increase the valuation, not those that improve profits, not those that feel good, not those that are pet projects of some executive, but the ones that are driven by a pro forma valuation enhancement. So we can use what we call the power of 5 logic. This is an economic sensitivity analysis, standard sensitivity analysis. So if you take a look at most manufacturing companies, there's about 7 major P&L variables, and about 8 P&L variables, about 6 or 7 balance sheet sort of variables. And so if you look at the top one there, price, if I raise my price, and this, by the way, comes from a real company. I can't tell you the name of the company because we worked with them and it's proprietary, but this came from a real company. And we discovered if we could raise the price by 5%, we could increase the value of this business, probably increase the stock price over a little bit of time about 51%. Everybody said, you can't increase the price. Nobody will buy from us. Okay, well, fine. What if we increase the volume? What if we sell 5% more? And that'll take the valuation up almost 34%. People said, well, I'm not sure we can do that without dropping price or without adding warranty or something like that. So then we said, well, what if we reduce our variable cost of goods, which is effectively reducing material spend? If I could reduce material spend by 5%, I could increase the stock price by 15%. Think about that, you purchasing professionals. If you could reduce the average purchase spend by 5% in this company, the stock would go up about 15%. What if we couldn't do that? So we look at semi-fixed cost of goods sold. That would be labor, mostly labor, by the way, and mostly both direct and indirect labor and even professional talent. So if I reduce the semi-fixed cost by 5%, I get 7%. Fixed cost of goods, the overhead, if you will. If I reduce that by 5%, I get a 27% bump. Oh, now we're talking. How do I reduce the overhead of the business? And then we get down to reducing sales expense and fixed sales expense and fixed sales and administrative expenses, fixed, semi-fixed, and variable. You see, I get very little out of that. And then in this case, if I reduce my inventories, I don't get much either. I've seen way too many companies focusing heavily on inventory, which, by the way, is important because inventory is just pent-up cash that's decreasing in value every single day. And so having a lot of inventory is not a good thing. But in this case, to improve the shareholder value of the company, it's not my top priority. In fact, a bigger priority is get down to the bottom. If I can get 5% more life out of all my machines and equipment, I can actually end up with about an 8.5% increase in valuation. When you understand your business variables, you understand your business priorities. That takes us to another moment of wisdom. Before heading to your company's annual mountaintop strategic planning retreat, you and your colleagues must receive appropriate education in your company's updated valuation model. That means that your CFO is responsible for sharing the realities of your valuation model. Understand that you are not eligible to discuss go-forward enterprise strategies until you thoroughly understand your company's fundamental economic model. Failure to achieve this understanding before establishing strategies will always and has always resulted in the wrong strategic priorities. Let that all sink in for a little bit. This is about understanding the economic model is a prerequisite to determine which strategies you should pursue and even which tactical directions you should pursue. In the transformation world, and I've lived it for 40 years, we have a term for this. We call it Valuation Targeted Continuous Improvement, or VTCI. VTCI is an approach, is a way of thinking about the business in terms of valuation and not allowing any continuous improvement project, not letting any improvement initiative happen unless one can justify it in terms of valuation enhancement. VTCI, this new term, starts with this critical economic reality understanding, an understanding of how this initiative that you're about ready to implement is going to impact cash flow and also how it's going to impact asset utilization, the denominator of the business. So notice the blue is my numerator, the green is my denominator in my cash flow over gross assets equation. Then we need to know what desired behaviors, projects, initiatives, activities, tasks we need to implement in order to impact the cash as well as to impact the assets. And then we can list the actual improvement initiatives that impact cash flows and gross assets. So economic realities exist for both cash and assets. Desired behaviors cannot be determined until the critical realities are fully understood. This means that the fundamental economic model must be developed. Now let me give you an example. Squint or blow this up on your screen because this is really important. This is about how to move from economic reality to behaviors. This is a template. This one's for cash flow. I'm going to do balance sheet or asset utilization in a minute. If you look at this very closely, you'll see that on the left side, I have critical economic realities. So the first one is that a 1% increase in aggregate product price improves adjusted cash flow earnings by 9.4% and valuation by 10.5%. The second one is a 1% increase in aggregate product volume improves adjusted cash-based earnings by 1.7% and valuation by 2.7%. The third one is a 1% decrease in variable cost of goods increases cash-based earnings by 6.1% and valuation by about 6.1%. And then you look at the second to the last one there, a 1% decrease in fixed cost of goods sold improves cash-based earnings by 0.7% and valuation by 0.6%. In other words, it doesn't do much. If those are the critical economic realities, let's now go and look at the desired behaviors. And so you see the very top one is total cost reduction have to exceed 5% annually just to protect the margin. In other words, if you really want to increase the value of the business, you have to find a way to have total cost reductions of 5%. And you have to actually find a way to raise your prices over time in order to accommodate that essentially commoditization in your marketplace. Well, let's go down to the third one. So the third one is the one I want to focus on for the sake of this discussion. I want to focus on a 1% decrease in variable cost of goods, material spend, gets me about a 6.1% increase in cash and about the same in valuation. What we're really suggesting is that we need to reduce raw material costs wherever possible. We also need to reduce scrap and rework. These are the things that impact purchase spend. These are things that impact all of that. Remember, if you waste purchase parts by scrapping it in your factory, then you wasted the purchase spend. And so from that, once we understand that, and that's a high priority, then we start to build our initiatives. We're going to implement lean principles, implement new and improved shift design, re-engineer products to reduce the off yield. So this is all very important. These are the initiatives. Notice the initiatives are focused on something that's a high priority, not a low priority. Adjusted cash-based earnings measures our ability to generate cash from our own operations. It excludes extraordinary revenues and expenses that are not attributed to or controlled by operating units within the enterprise. So these are real numbers. Let's take a look at the balance sheet now. Let's take a look at how to move from economic reality to behavior on the balance sheet. Effectively, we're looking at capital efficiencies. And again, one of the things I'm going to do is I'm going to select, in this case, the fourth one to look at. A 1% increase in accounts payable days, that is days outstanding for paying, improves gross asset turnover by 2% and valuation by 1.5%. And so if I take a look at the behaviors that I want, so that's the critical reality. Now the behavior is I need to stretch payables as far out as possible while also taking all economically advantaged discounts. That becomes the desired behavior. So now what are the initiatives? Well, try to get 3% fast pay terms, negotiate quarterly payment terms on commodity type items, negotiate longer term agreements that come with longer payment terms to compensate for reduction in risk to the supplier. Again, we're using the gross asset turnover measures here, which measures our ability to put our cash generated from product sales and customer service activities to work in a productive manner that then allows us to reinvest in the business and subsequently grow enterprise valuation. That leaves us with 4 practical considerations that describe real links between internal improvements and shareholder value. The first is, will the internal investment, the one that's being described by my continuous improvement project or by some executive-led initiative, will this internal investment reduce my direct costs, the variable costs? Will this internal investment allow me to charge a higher price to my customers by delighting them more? Will the internal investment lead to increased shipping volume? Will it actually grow the market? And will the internal investment reduce my incremental semi-fixed and fixed cost? Usually by increasing volume, but it could be reducing the actual assets and asset costs themselves. That leads us to a moment of wisdom. Improvement initiatives should be driven from an understanding of economic priorities. Not strategic priorities, but economic priorities. Strategic priorities are established. Strategy priorities are established from understanding how it will impact the valuation, not the profitability, not the earnings per share, but the valuation of the business. So let's wrap this up. Here's a final thought. We all ultimately work for the shareholders who are at total risk. It is our job to both enhance their value and protect their value. This cannot be accomplished without understanding that asset investments on the balance sheet are just as important to manage as profits depicted on the P&L are to be achieved. We are commanded to achieve an appropriate return on shareholder investment on the employed capital that they gave us. My critical insight to wrap this program up. I have seen too many companies who get carried away with the customer proposition without ever considering the shareholder proposition. This usually occurs in companies where all leadership team members, or most of them, seem to fail to comprehend that all strategies are designed to protect and or to grow and or to sustain the shareholder value. Neither customer satisfaction or product quality are ultimate goals in any manufacturing company. They simply represent a category of strategies that are designed to move the shareholder value needle in a positive direction. I have to tell you that we can oversimplify transformation of companies. I hear all the time, all I have to do is improve quality. Well, quality needs to be what the customers expect and no more. Or all I have to do is reduce my inventory. Well, inventory, while being the giant sucking sound of capital, is also extremely important in the customer satisfaction arena. You run out of the inventory, you don't sell, customers go elsewhere. So it's very easy to oversimplify the priorities in a manufacturing company. That's why we believe that you need to reduce everything to the common language that turns every single, or that ties every single department and every single organization together, and that would be shareholder value. Thank you for attending another Manufacturing Executive Institute Global Supply Chain Improvement Series e-learning event. This program has been sponsored by GDI Consulting and Training Company, developed by the Manufacturing Executive Institute, and produced by Radio MEI. To find additional relevant and useful e-learning programs, go to www.mfgexecutive.com. Now go and make a difference.